Hello there, welcome to Proactive Investors London. My name's Polly Middlehurst. We're talking once again to analyst at Capital Network, Ed Stacey. And just before I do, reminder that Ed's full report is available by pressing the I in the corner of your screen. Hi to you, Ed. Talking to us today about Staffline. What do they do?
So Staffline is an outsourcing company, mostly in the UK and Ireland. There's two divisions. Staffline Recruitment does temporary staffing for industrial customers, so things like food companies and distribution warehouses, the likes of Tesco's, Marks & Spencer, lots of other big customers. The other division is called People Plus, and that's an employment support and training services business. So it's things like back-to-work schemes for government and for local authorities, also apprenticeship schemes in the private sector, and even things like offender rehabilitation in the justice system. So two divisions. The reason we think Staffline is really interesting now is over the last 15 years, it's been really one of the big growth plays in the staffing sector. But right now, the shares are trading on a discount valuation, so we thought it was an interesting time to look at Staffline.
So, Ed, how are each of those divisions that you mentioned in Staffline performing right now?
Well, Staffline Recruiting, the industrial business, is doing very well. The key here is their very effective managing of the employee base. The mantra is provide the employees with the work they want, where they want, when they want it. And they're able to retain a workforce of over 50,000 individuals. That allows them to provide reliable, high-quality service to these industrial customers. And the proof really is in the numbers. In 2017, a tight labour market, not necessarily an easy time for a temping business, but Staffline Recruiting grew at 9.5% organically. So they're gaining market share even when conditions are not necessarily easy for the industry. Big growth for Staffline Recruiting, so that business is going very well.
Now there's another aspect to the Staffline story, of course, People Plus. Bit of a different story there too.
Yeah, well in some ways it's the same sort of story as Staffline Recruiting. So People Plus is that training business, and like the recruitment division, it's delivering on its contracts, it's consistently best in class in the markets it operates. But as you say, there is another factor in People Plus. There's one big programme called the Work Programme. That's a UK government scheme, and it was announced at the start of last year that scheme's being phased out, basically because unemployment is at a pretty low level anyway. So now, obviously, when you're winding down a big revenue stream like that, it does impact the numbers. So in our report, we've got a big focus on showing what that winding down of the Work Programme does to Staffline Group numbers. Now, we still have growth in our forecast in 2018 for group earnings, but compared with the previous 5 or 10 years, if you look at 17, 18, 19, it's a slower growth period for group earnings growth compared to what we've been used to. But after 2019, that work programme is fully wound down, it's finished, and then I think thereafter you would see the kind of very strong growth in Staffline that we've seen in the past.
Just lastly, Ed, flesh out for us this discount valuation people are talking about in relation to Staffline right now.
Yeah, so we've got it on 8.5 times PE, so that is a cheap valuation for a big structural growth story like this. There's two things I would urge every investor to look at. First thing is if you go to Staffline's investor relations site and look at the investment case, so there's a tab called investment case, that shows you all those long-term numbers, the tremendous growth story in terms of revenue and earnings. Then also look at the share price chart, that's the second thing to look at. There's been two periods previously where you've had a slowdown in this very strong earnings growth, 2008, 2009, and then again in 2012. When you've had a bit of a slowdown in earnings growth, the shares derate, you get a cheaper multiple. Those previous two occasions were tremendous buying opportunities. So that's why I think people should really be looking at Staffline, asking themselves, is this just another temporary slowdown in earnings growth? Certainly seems to be. If so, then this cheap valuation gives you a tremendous buying opportunity. So definitely I think worth looking at on valuation grounds.
As always, an outstanding update from you, Ed Stacey of Capital Network. Thanks very much indeed. And as I said at the beginning, if you want to see Ed's full report, click on the I in the corner of your screen.